But today, as I said, they'll be speaking on a very different topic. Please welcome for the first time Bradley Polizzano.
So has anyone been to the Resorts Casino in Queens? All right, we got a couple hands. Or the Empire Casino in Yonkers.
Yonkers.
Yonkers. Well, like it or not, gambling is increasing in New York State. In addition to the racinos that I just mentioned, where there's millions of dollars pouring into the state coffers, this past election day, the voters approved a statewide referendum authorizing up to 7 full-scale commercial casinos in New York State. So it's going to start with some casinos in upstate New York to generate jobs and tax revenue as resort destinations, and a decade or so from now, we may actually see full-scale casinos downstate, maybe even in in the boroughs or here on Long Island. So we're at the infancy, really, of expanded gambling in New York State, and I think it's a great topic for us to start thinking about.
So I'm glad to be back here with you now from this morning, and good to be talking about gambling with you. Brad here is the expert on gambling and the gaming industry in general and the taxation of it. He writes a very nice blog about it and keeps up to date with all of the most recent developments. When lobbyists in New Jersey want to know how they should draft legislation concerning tax, they give him a call. I am here because I know how to gamble. I have, like you, been to the casino, and because I am a tax attorney and therefore inherently egotistical, I feel like I have a position here to tell you what I know about it. So that's where we're going to begin. I'll let you know what I know. So if you gamble and you win a lot, I know that I've been given this form from the casino, this W-2G form, about when I win, a good amount of money on slots or poker, whatever I play. And my understanding is I just report those W-2Gs. I give them to my accountant, and he puts it on the tax return, and that's pretty much the only tax, right? I mean, is there anything else that I even need to worry about?
Quite a bit, Christopher. A lot of taxpayers assume that only the gambling winnings that are on their reported W-2Gs are taxable income, and they could not be more wrong. All taxable winnings all gambling winnings are considered taxable income. The Internal Revenue Code, Section 61A, says clearly all income from whatever source derived is included in gross income.
What about the scratch-off tickets, like lottery scratch-off? You buy the new state lottery ticket, scratch-off, win $5, $10, $1,000. What about like if I play like a local game with my friends and just win a little bit of money, here and there?
Included, and I'm sure you report it as well.
And what about like office March Madness pool? Like not that I win the office pool, but when I win next year, the March Madness pool in the office, and take home maybe $100 or something like that. That's not going to be taxable, is it?
Well, it's good to hear that you engage in illegal activity, Christopher. Income from illegal sources, also taxable income. There's no exception.
Well, I'm a little disappointed here.
Well, it's a rude awakening, Christopher. And not only are you required to report it, but you're also required to maintain a diary of all your gambling winnings and losses. I'm often asked the following. If there's one piece of advice that I could give to a taxpayer with gambling winnings, what would it be?
Let me guess. I think it's something about probably not spending all that cash in one place, put it in the bank, not under the mattress. Is that along the lines what you're thinking?
No. The answer is to keep very, very, very good records of the gambling activity. If a taxpayer who reports gambling income is audited, an IRS agent may ask the taxpayer for records substantiating the activity. the burden of proof is on the taxpayer to prove their gambling losses. I've seen time and time again taxpayers who fail to provide sufficient records for their gambling activity, which will result in additional tax penalties and interest. So, question is, what kind of records are the IRS looking for? IRS publication 529 states a taxpayer must keep an accurate diary or similar record of all losses and winnings. The diary should contain the date and type of the specific wager or wagering activity, the name and location of the gambling establishment, names of other persons present, and the amount won or lost. The point here is that the IRS likes contemporaneous records. They give the aura of authenticity, that a taxpayer didn't get audited and then just suddenly and hastily put something together to substantiate their winnings and losses. Computer records are possible. If they want to keep a diary on Excel, there's some more details in IRS publication 552 to maintain records in what's called an electronic storage system.
And here is something that I do have some experience with is handling audits of people that have been gambling and have been scrutinized for their gambling records. And I don't know if you've seen this, but certainly sometimes casinos will give a gambler a single page. Here are your net winnings or losses for the year, and they always say estimated net losses for the year. And that's what you're given. What shows up on the tax return is just that. Maybe there are some the W-2Gs maybe show up also on there. But if you approach the IRS with that, they will ask you to go back and get more. It certainly is. It's a hard situation to be in because they'll tell you, look, we're not going to let you have those losses unless you can give us some more substantiation. And it's really a tough burden to go back without any kind of diary or log because they do ask specifically for that. If one's kept, and to have to go back and recreate it from the bank statements or anything like that is a lot of trouble.
Speaking of the diary, the third item listed there, names of other persons present. To me, it seems ridiculous that if you're sitting at a poker or blackjack table, they have to ask the other patrons for their name. It just seems incredibly awkward. Excuse me, what's your name so I can keep it for my gambling diary? I mean, I don't know what the IRS envisioned here. Maybe if you're playing with your friends, okay, fine. But to ask a random stranger for their name, for their log, just seems over the top. I mean, is the IRS going to reject the diary if you didn't keep the names of other people you played with? That would seem to be overly aggressive on their part, but it is listed there, so I digress.
So amateur gamblers, just casual gamblers, let me see if I can move this, report all of their total gambling winnings on line 21 of the 1040, just as other income, and report total gambling losses as an itemized deduction on their Schedule A. There are several possible tax consequences I'm sure that you can think of from the separate reportings of winnings and losses in this way. If a taxpayer's total itemized deductions are less than the standard deduction, of course, then the gambling losses have no benefit whatsoever. If gambling winnings are included in the AGI, but gambling losses are not, then you have an inflated AGI that can limit your ability to take other deductions. For example, the medical expenses or the 7.5% other certain miscellaneous deductions are limited. And certainly, having that higher AGI could also trigger the alternative minimum tax, having the larger itemized deductions. I should differentiate the fact that the gambling losses are other miscellaneous deductions, not certain miscellaneous deductions on that Schedule A. So there's no percentage limitation on taking them. It's not subject to that 7.5% haircut, but they are they're on the Schedule A. So my question, of course, then is that if you have to report your winning sessions as income and your losing sessions as losses, what is a session? It seems like the more that I could net my games, the better. So when I go play for a weekend, can I just treat the whole weekend as one session and be done with it? Or is there anything else that I need to worry about?
Well, we need to worry because there's minimal guidance on this, either in the tax code or in case law. There's one case, LaPlante versus Commissioner from 2009, The U.S. Tax Court said that a taxpayer can net all slot machine play, so all their wins and losses from playing slot machines, in a single day as a gambling session and use that net figure for winnings. Or if they're an overall loser, then it's a zero. There's no court precedent addressing any other casino game, poker, blackjack, roulette, etc. So we don't know. So what do we do in that situation?
Well, I would say that typically if there's no definition in the statute, then courts typically like to apply the ordinary meaning of the word when it's not defined by the law. And so, in the Merriam-Webster dictionary, there's 6 different definitions for session. That I looked them up in advance here. The most relevant one reads, a meeting or period devoted to a particular activity. So applying that definition to gambling, I would think that it would really kind of depend on what you're doing. I mean, I can think of some situations like tournaments that may have a different sort of result than just sitting down and having a cash game.
Right, and Christopher's more specifically referring to poker. So if you've ever played in a poker tournament, you have a buy-in entry, fixed fee, and either you win nothing and you lose, or you win a specified sum. To me, it seems pretty clear, one poker tournament is one session of continuous play. So it gets more complicated if we talk about cash games. If you go to the casino, there's no table poker games in New York State, but if you go to, let's say, Atlantic City and you play poker and you sit down at a cash game where you just can put down a couple $100, it's up to you, and you decide to play for 2 hours, or you play for 2 hours and you take a break for 3 hours, and then you go back for another 2 hours, but for the first 2 hours you win and the second 2 hours you lose, what do we do? So again, going back to the definition of a session, continuous play seems to say that if you have a 3 hour break in between, they actually have to count those 2 different sessions on your diary. So theoretically, on your gambling diary, you can have multiple entries in a single day if you're playing for different specified times and different games. So if you go from one game, let's say you go to the slot machine, you pull the handle, or now it's more pressing buttons than pulling handles these days, but you pull the handle and you win $1,200, then you run to the roulette table and spend 2 hours there and have wins or losses. Those are separate because they're different games. So it's a mess, and nobody does this. Nobody really keeps track and to this extent, but if they want to substantiate significant gambling losses, this is what the IRS is looking for.
And one of the other things that is becoming more prevalent, I know, is online gambling and online poker play. And one attractive aspect of online play is the ability for a single player to play multiple tables simultaneously. So to the extent I think that there's like multiple table play going on at the same time, I would think that would also be one session, one continuous session, and be netted together. We'll talk a little bit more about online gambling and the tax aspects of it later on, but that seems to me sort of how it would be treated. So we've covered the rules sort of basically here for amateur gamblers. So what about professional gamblers? How do they treat their winnings and losses?
First, we have to acknowledge there is a such thing as a professional gambler. They report their gambling winnings and losses on Schedule C, just like any other trade or business. It's viewed under the tax code as engaged in the business of gambling. The taxpayer may net all their gambling winnings and sessions and report the resulting amount on a Schedule C. There's a limitation on deducting gambling losses, not to the extent beyond gambling winnings, so they can't report a net gambling loss. But the point here, in part, is that relative to amateur gamblers, they'll have a lower AGI because they are netting their gambling winnings and losses together on the Schedule C, and they'll have business income as opposed to separating between line 21 as other income and an itemized deduction. Also, the professional gambler is viewed as self-employed, so the taxpayer may also deduct ordinary and necessary business expenses incurred in connection with the business, and we'll go on with that shortly.
So, Brad, I've already decided that I want to lower my AGI, and I certainly want to deduct gambling-related expenses. So how do I become a professional gambler? I figure I need to make at least maybe a monthly trip to the casinos. Maybe a few friends of mine, maybe you and I, maybe we'll get Bob and Iola to join us for like a weekly poker game, and will that be enough for me?
Professional versus amateur gambler status for tax purposes is a facts and circumstances determination, just like it is for any question of whether one's engaged in the trade or business. Taxpayer can't just choose whether they're a professional or not so that they can lower their tax bill. There is, in fact, United States Supreme Court precedent on this issue. In 1987, there's a case, Commissioner versus Grotzinger. The court established the professional gambler standard. Believe it or not, the highest judges in the United States looked at this. And they said if one's gambling activity is pursued full-time, in good faith, and with regularity to the production of income for a livelihood and is not a mere hobby, and that's key, it is a trade or business. So in that case, in 1978, Mr. Grotzinger was held to be a professional gambler. He spent 60 to 80 hours a week at dog races. Gambling was his full-time job and livelihood. The court recognized this. And what's even more interesting, in that case, the taxpayer had a net gambling loss for the year. He didn't even win. And yet the court still said he was considered a professional. So the point is that you don't have to necessarily be a winner in any particular year to say that you were a professional. So since that case, over 20 years ago, the IRS and several state tax agencies have been challenging the professional gambler status claimed by taxpayers. And there's a common theme among the cases where the taxpayer loses. They spend substantial time to generating non-gambling income. The point is that you have to be spending a lot of time on this. It's not, as Christopher asked, going once a week to the casino or playing with some friends every now and then. It's not that simple. Question?
The problems you have, I think, are past the federal. I really think they get much more in New York State and or New Jersey.
And we're going to touch upon the state tax issues later. That's a great question.
And New Jersey hasn't even.
Right. We'll get to the state tax impacts here.
Great question. State tax is a whole other concern. So, in addition to the test set by the Supreme Court, the tax court and state tax courts sometimes apply a non-exhaustive 9-factor test for evaluating whether one is engaged in the trade or business of gambling, and it's found in the Internal Revenue Code regulations.
Right, and those regulations are the tests for professionals of all types. So, let's just quickly consider sort of how they would apply to gambling. So the factors in the regulations include the manner in which the taxpayer carries on the activity, the expertise of the taxpayer, the time and effort expended, expectations that assets used in the activity may appreciate in value, and it seems very odd for us to think about an asset in gambling. But I know that certainly I would think that in the gambling world, certain gamblers have themselves sort of have an asset value that they can in their brand and in their ability to get out there and market themselves in certain ways. The success of the taxpayer in carrying on the activity, the taxpayer's history of income or losses, the financial status of the taxpayer, and then my favorite at the end is elements of personal pleasure or recreation, which when applied to gamblers, I would think really cut hard for a lot of them. But no single factor is determinative, so the burden of proof is on the gambler to prove the professional status. And whether one should file as a professional gambler is really based on those facts and circumstances. But in most cases, I guess it should be pretty clear that I would not be a professional gambler.
So as I said before, the Internal Revenue Code does permit the deduction of gambling losses, but only to the extent of gambling winnings. So a taxpayer can't report a negative gambling loss for the year. They can't create a net operating loss carryback or carryover, or they can't carry to a previous or future tax year gambling losses to offset years of wins.
So it doesn't matter whether a taxpayer is gambling as a hobby or as their profession. There's no net gambling losses allowed, but But you're telling me that if there are gambling losses one year, then gambling winnings the next year, the winnings and losses aren't going to offset each other?
That's correct. It's a harsh rule for the tax code, and I see hands raising. I just want to say we have a lot to cover. I'm happy to answer all your questions afterwards. Come find me or call or email. It's fine. I am flattered by the interest, though. So feel free to ask. Right. So back to Christopher's question. You can't offset a winning year with a loss year. If you have a loss year, it's zero. It's that simple. However, there is one way a professional gambler may, in fact, report a business loss. So how might that be?
I'm thinking that the professional gambler can deduct their ordinary and necessary business expenses, and they can do that beyond the extent of the net gambling winnings or loss for the year, and thus report a business loss from gambling activity, even if it's not from the gambling itself. So a professional gambler is a net loser for the year. Those gambling losses can only be deducted to the extent of gambling winnings and have a net zero gambling winnings on the Schedule C, but then there are other expenses that would make it a lost year and create a loss on the return.
And in fact, the U.S. Tax Court looked at this specific issue in 2011, Mayo v. Commissioner. The tax court held that a professional gambler may deduct ordinary necessary business expenses beyond their net gambling winnings for the year and, in fact, have a business loss from that. So a couple typical deductions for professional gamblers. Their travel, if they're traveling to casinos throughout the United States. This is more typical for professional poker players. You may have heard of people like Daniel Negreanu or Chris Jesus Ferguson. I could go on, but I won't bore you. There are professional poker players, and some of them make quite a bit of money. Meals and entertainment is another typical type. You have taxpayers that may be able to take a deduction for business use of their home, and that's really getting at a professional online poker player who's actually generating income by playing online poker. Some gamblers try to hone their skills with classes or coaches so that they can stay on top of the trends of the game.
And again, all of these expenses, you're all accountants. I imagine you know these rules backwards and forwards that people claim. So we're going to sort of skip ahead a few slides here. But one thing that I was thinking of when you were mentioning all of these, especially the meals and entertainment expenses and getting a deduction, is who pays for that? If you go in and gambling any amount of money, they give you free drinks, they give you some free food. If you put a lot on the line, they may even give you your hotel room for free. All of these casino comps, that you're getting for free, you're not, the gambler may not even have to be paying for those things. But I sort of, question sort of whether or not the receipt of all those comps are income to the gambler.
Well, there's no exception. Again, there's no exception for gambling winnings from Section 61A as what's included in gross income. The fair market value of comps received by gamblers is taxable income. The casinos will report larger comps on 1099s. There's no de minimis exception.
And comps, to me, seem to sort of be part, really, of the whole gambling transaction. As part of the activity. You get the comps as part of it. After all, the player, I don't think, clearly wouldn't receive them if it wasn't for the gambling activity. So, of course, the taxpayer is going to have to include the value of that comp in income. But what if the player had a net loss for the year? So, for example, a gambler goes out. If I go and lose $10,000 gambling one weekend and go back the next weekend and win $5,000 back and have this net loss of $5,000, but I also get a 1099 for $3,000 worth of comps. Can I use all of that? Can I use the gambling loss to offset that comp income that I might have?
Possibly. Another issue that the tax court has looked at, Labouty versus Commissioner in 1996, the court said comps can be offset by gambling losses if the comps received are, quote-unquote, incident to direct participation in wagering transactions. That's how the court laid out the test. In that particular case, there was a taxpayer who spent a lot of time at Trump's Casino in Atlantic City. And over the course of 3 years, the taxpayer received $2.5 million worth of comps. in the form of jewelry, automobiles, vacations, champagne, etc. This is how they get people to stay. I mean, like gambling or not, I mean, that's what they do. And so he received several 1099s for those years in the fair market value of these expensive prizes. And he said, wait a second, I lost a lot of money at your casino. I'm not paying tax on all these comps. And the court said, you know what? The fact that the senior management at Trump, in their discretion, decided to award the comps to him because of his gambling activity, they said that's closely tied enough to the gambling that he can offset the fair market value of those comps with his gambling losses. Now, I mentioned that case earlier, Mayo v. Commissioner. They actually, in a concurring opinion, looked at this test and said that it's questionable. They really feel that gambling winnings should be from actual playing of the game and not some other form of comps or any other type of income. But a concurring opinion is not law. So as of today, comps can, if they meet the test in the Labuti case, can be offset by gambling losses.
All right. So one of the things that we do need to talk about is non-residents of the United States and coming into the United States for gambling, because the situation is quite different. In general, gambling winnings paid to foreign individuals are subject to the 30% withholding. And so, for example, a Canadian resident wins $90,000 in gambling in the United States. There will be withholding of $27,000 for U.S. taxes, and the winner walks away only with $63,000 in their pocket, and also walks away with the 1042S foreign person's U.S. source income subject to withholding that they need to keep, and obviously report when the time comes, reflecting that $27,000 withheld.
And note that the 30% withholding rule applies only if the income's not effectively connected to a trade or business in the United States. So if you have a non-resident who's engaged in a trade or business of gambling in the United States, and this does exist, then there won't be 30% withholding. In addition, there are tax treaties between the U.S. and other countries that exempt gambling winnings won by non-residents in the United States. And there's a long list of all the countries that if a resident of any of those countries that has gambling winnings in the United States, it's not taxable.
And note that it's not just that it's not subject to withholding; it's not taxable under those treaties. So there's they actually do at least for this list. There is no tax in the United States. There are other tax treaties that just reduce the percentage of gambling winnings in the United States and reduce the withholding, the tax rate on them. I would say, if your client is a non-resident, just be sure to find out whether the U.S. has a tax treaty with the resident country and whether it addresses gambling winnings. Claimants need to provide the payer one of the Form W-8s, either the BEN or the ECI form, in order to gain benefits to those tax treaty benefits and get out of the withholding. And they're especially useful for non-resident gamblers, because compared to U.S. residents, non-residents gamblers have it far worse when calculating the gambling winnings and losses.
What Christopher's alluding to is that for non-residents, gambling losses are not deductible at all unless they're connected to a trade or business. So the rule that I said before that a taxpayer can deduct gambling losses doesn't apply to non-residents. That's the law. There was a recent case that I want to mention, Park v. Commissioner. This was in the D.C. Circuit, where the IRS held the view that instead of a per-session basis for separating gambling's winnings and losses, as I mentioned earlier, that the non-resident rules, you have to apply a per-bet determination for separating your gambling's winnings and losses. And think about that. So you have a non-resident playing blackjack. Every single bet has to be either a winning session or a losing session. So if they play for 2 hours, every single winning bet is taxable, and they can't even offset all those losses. Now, to the extent that this is actually enforced is an entirely different question. But in this case, the D.C. Circuit rejected the IRS view. They actually overturned the lower court and said, you know what? That rule is ridiculous. We're going to allow a per-session basis for non-residents to separate the winnings and losses in the United States.
Yeah, but you did hear that right. The tax court actually sided with the IRS that non-residents should be taxed on a per-bet basis on these and not be allowed any deductions for any of the losing bets. One of the other things I think that comes up and sort of is in the back of my mind is sort of being on the side of sort of having to substantiate and defend taxpayers is having sort of what Brad said that a lot of times it's not easily enforceable, some of these rules, but with the advent of online gaming, online gambling, there's electronic transactions for all of these things. It's very obvious. I know that it's been in the news. Online gambling has been in the news lately. I haven't been engaging in online gambling some, but would like to. And I know that Brad already told me that I'm a criminal for engaging in my March Madness office pool in that illegal activity. So I guess my first question is: online gambling even legal in the United States?
Well, the short answer is it actually depends on state law for the most part. But just to give you a little bit of background, you may have heard a couple of years ago, in fact, April 15th of 2011. The Department of Justice seized the internet domains of the three largest offshore online poker websites: Absolute Poker, Full Tilt Poker, and PokerStars. And several of these sites' principals, as well as individuals processing financial transactions, were indicted for bank fraud, illegal gambling, and money laundering. And in connection with that, there's a law that passed in 2006. It's called the Unlawful Internet Gambling Enforcement Act, also known as UGIA. And it makes a federal crime for gambling businesses to knowingly accept forms of payment in connection with the participation of another person in unlawful internet gambling. It's a mouthful. Whether or not the internet gambling is considered unlawful requires the triggering of the violation of another law, either federal or state. And so what happened here was that these banks just looked at this law and said, we're just not touching online gambling transactions. We're not processing them. So these companies actually disguised the nature of the transactions to get the funds to and from the players' accounts and said that the transfers were for golf balls and pet supplies so that the banks would actually process them. And that's what ultimately led to the sites getting shut down. They weren't actually brought down because they were breaking gambling laws. It was because they were breaking other laws so that they wouldn't touch a law that may have been saying that online gambling was illegal. So, turning now to what the status of online gambling is today, again, it depends on state law. And there's been significant movement towards legalizing internet gambling here in the United States. The Department of Justice changed their stance on what's called the Interstate Wire Act of 1961. Basically, the Department of Justice previously held that this Wire Act applied to all forms of gambling, and so it made online gambling illegal here in the United States. But then in December of 2011, the DOJ just changed their view. They said, oh, you know what? This Wire Act, it only applies to sports betting. So that actually gave a green light for states to legalize internet gambling within their borders. And it's now happening. You may have heard in the news that New Jersey, just last month, opened its doors to internet gambling. If you are physically present in the state of New Jersey, you don't have to be a resident. You just have to be physically there. You can deposit money and play on various Atlantic City casinos' websites. So it's coming. There's other states considering legislation for this. There's going to be a domino effect. Again, like it or not, the states are desperate for revenue, and New York State, as I mentioned earlier, is opening up its doors to commercial casino gambling. I think online gambling's next, right here. I mean, I think 3 years from now, some of you could be sitting at your laptops and playing. It's theoretically possible.
But not during our speech.
Of course not.
And in general, I mean, online gambling winnings are taxable when they're credited to the taxpayer's online casino account. We get this from people various times. I'm sure you can see where this is going. There's a very often a misunderstood concept, but there is the doctrine of constructive receipt. So it requires cash method taxpayers to include an item in income even if they haven't received the cash yet. So you have people that play online, that just sort of accumulate the money in their online gambling account, but don't take any of the money out and say, oh, no, I haven't earned anything yet because I haven't converted back. And a lot of these online gambling sites don't necessarily do business in U.S. dollars. They use some other form of denomination while you're on the site, and then you can essentially cash it out and cash out your chips and take it at that point. But as soon as you have the ability to take it out, you have constructive receipt of the item, what is set apart for the taxpayer, and they can do it at any time, and made available to them to withdraw, that is actually income. So that's something else that I would think would be something to watch out for. And like I said before, from a records keeping standpoint, actual withdrawal and deposit of amounts don't mirror the actual winnings and losses. And with digital play, they'll soon be able to obtain, I would think, quite easily the win-loss records from players. And for both players and the tax agencies will be able to get that information. And it may end up as sort of a rude awakening for players that previously weren't aware that all of these gambling winnings are taxable. And it may end up as a real boon to federal and state coffers if a high percentage of gambling winnings end up actually being reported on income tax returns that previously might not have been.
So I just want to briefly turn to the consequences of you have a lot of players that were quote-unquote victim of the Department of Justice seizure of these offshore online gambling websites. Well, some of them actually left the U.S. to continue playing in other countries. And so we just want to briefly touch upon the consequences of doing so. They're still subject to income tax. As we know, the U.S. income tax system is a worldwide system. So you pay income tax if you're a U.S. resident, whether it's earned here or abroad. Online gambling winnings earned abroad, it's no exception. If, however, one is a professional gambler, they may qualify for the foreign earned income exclusion. For the 2013 tax year, a taxpayer who qualifies for the foreign earned income exclusion may exclude up to $97,600 of foreign earned income. Now, I say professional gamblers because amateurs can't make use of this test. To qualify for the foreign earned income exclusion, they must have earned income, which is a statutory term, and it includes wages, salaries, tips, and other employee compensation, as well as business profits earned from a professional occupation. Income from gambling, otherwise, if you're not engaged in the trade or business, would not qualify.
Yeah, and the other thing to remember for people that are overseas, obviously, are things like the FBAR reporting that I know we all have been made very well aware of now. One of the things that is a little strange to online gambling is whether or not one of these online casino accounts is subject to FBAR reporting, and it's a little unclear whether or not it would classify as a pooled account, whether or not that would be subject to reporting on the FBAR. And in general, I would say the more prudent thing to do is report it and don't get into trouble with it. But that's something else to think about if you have a client that is starting to engage in online gambling, whether or not they have a foreign online gaming account. Let's move with the time we have left, I think, straight ahead to the state tax issues, though, so we can get to those because they are very interesting.
So each state has its own tax code, and as we all probably know, not all states impose a personal income tax. 7 do not: Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. New Hampshire and Tennessee impose a personal income tax only on dividend and interest income. So that leaves 41 states that impose a general income tax. And in general, a state that imposes a personal income tax levies a tax on gambling winnings of its residents. This rule mirrors application of the federal tax law as applied to gambling winnings. I would caution to check your own state-specific rules. We'll talk about New York shortly, because there are exceptions, and I just want to point out one in Connecticut, that if a resident filing single has lottery winnings, they don't have to pay tax on them if their overall income is less than $13,000. Not a big number, but I just pointed out that there are some exceptions on the state level.
And on the deduction side, there are some very different. It's a very different story. Some very different than the federal guidelines, and it's not in a good way for the taxpayers. So some states limit the extent a taxpayer can deduct gambling losses, and in fact, some states do not permit a deduction for gambling losses at all. These limitations are beyond that limitation for deducting gambling losses under 165D of the code, where it permits them to the extent of gambling winnings. So it makes a big difference for those people what a session entails, and to be able to try to net as much as possible into one session. So keep in mind that these limitations do only apply to amateur gamblers. Professional gamblers are not subject to the limitations because it's incurred with the trade or business of gambling. So they are able to make full use of those losses. But unsurprisingly, there are many tax cases in which a state tax agency challenges, often successfully, a professional gambler status. If somebody claims they're a professional gambler in order to take advantage of being able to deduct all of their losses, that's really what the states have gone after. So it certainly is a big deal.
So I'm just going to mention the rule in New York. It's listed there. There is a limited deduction on itemized deduction, and this applies to all itemized deductions in New York. It's under New York Tax Law Section 615F. It imposes additional limitations on itemized deductions, and for single taxpayers, if a taxpayer's New York AGI exceeds $100,000 but is less than $475,000, then their itemized deductions are subject to a 25% write-off. They lose 25% of their itemized deductions. If their AGI is between $475K and no more than $525K, then they're limited between 25 and 50% itemized deductions on a sliding scale. If they have AGI above $525K but no more than $1 million, then the itemized deductions are subject to a 50% reduction. So big numbers, as some of your clients probably experience for other types of deductions, and gambling is no exception. If their AGI is actually above $10 million, then the only allowable itemized deduction is 25% of gifts to charity. So it's real awful for higher AGI taxpayers. And this kind of comes full circle with mentioning that only gambling winnings for most gamblers are included in AGI. There's no losses in AGI. So if you have a taxpayer that just gambles a lot and accumulates 150,000 of gambling winnings and 150,000 of gambling losses, then you have to reduce their losses by 25%, and now they have taxable income of $37,500, even though they broke even. And the problem exacerbates when they have higher gambling winnings and loss numbers. So it's something definitely that is unfair to the taxpayer, and I question whether the expansion of commercial casino gambling will compel the state legislature to look at this rule, because it's making taxpayers pay income tax on phantom income.
Another area of state tax law that comes up here is the allocation rules and sourcing rules for the various states. When a resident of New York gambles in New York, there's no question that it's New York source income. That gambling income is New York source income. But when you have taxpayers crossing state lines and having gambling winnings in other states, it becomes a different story. So, for example, if you go into New Jersey will tax non-residents on gambling winnings from New Jersey, because they consider gambling winnings that are physically earned or physically won in New Jersey to be New Jersey source income. On the other hand, many states, including New York, say that is the income that's sourced based on the residency of the gambler. So New York gambler that goes into New Jersey has New York income according to New York, and New Jersey income according to New Jersey, and everybody's going to want to tax them on that. And of course, the real poor thing about this for the taxpayers is that the credits don't fully offset either there, because you can't get a credit unless it's sourced to the other state. So when New York looks to give you a credit, they're not going to say, oh yes, well that gambling income is sourced to New Jersey, so it doesn't give you the credit for the taxes you paid there. And it's it really just depends on what the states rule. But certainly what I discussed earlier, where two states can certainly say that source income that we consider that income source to us. If they have the ability to do it, certainly a constitutional thing for them to do that's been upheld. So is something definitely to look out for.
So just to wrap up, as you could tell, it's not quite so simple when you're addressing your client's gambling activity. It could depend on a variety of things, whether they're professional or amateur, whether a U.S. resident or not. And in addition, the emergence of online gambling in the United States is going to raise more tax questions that haven't been raised by previous physical casino gambling. So thanks for your time today, and just remember to tell your clients, when it comes to gambling, the tax man always wins. So nerdy.
If anybody has a few questions, I think we do have a couple minutes here.
I'm sorry, we do have a couple minutes for questions, if you remember what you wanted to ask.
I don't have a question. If you're a New York resident, you go to New Jersey, and you win money, your only losses are New Jersey losses against that. And that is a gross income state, therefore it's netted against the gross income, not an itemized deduction.
Right. The point.
Make that clear.
Yeah. The point was that if you're in New York and gambling in New Jersey, that everything is sourced. That both the income for the winnings will be sourced to New Jersey. Also, the losses are New Jersey losses. Only New Jersey losses, right? For when you're doing your New York returns, right? Or New Jersey returns as well. Yeah. Right.
Question in the back.
Self-employment tax, right, is the question?
The question is gambling income subject to self-employment tax, and the answer is only if the taxpayer is considered a professional gambler. Then it's just like any other Schedule C self-employment tax issue. So could someone else repeat his question? I'm sorry, I can't hear your question. Oh, okay. Well, my understanding is that the professional gamblers do have to pay self-employment tax. But thank you for your point. Yes, question.
Well, I'm not sure I heard you correctly. You're saying the New York resident gambler goes to New Jersey, so the income's taxed in New York and New Jersey, and the loss is deducted to saying it's New Jersey, but not New York. And you don't get a credit because.
Yeah, I mean, the reason you don't get a credit is because when New York looks at that gambling income, then they say that is sourced to New York. So when you do the credit calculation, it doesn't increase the credit amount.
New Jersey says no credit because it's sourced.
Right.
Yeah, New Jersey does the same thing. Yeah.
But I thought you said something about the loss.
If you have a loss, a gambling loss, again, New York says that's a New Jersey loss in New Jersey. So when you do your New York and New Jersey returns, you just have to keep that in mind. The loss is the same way. You just have to allocate them to the correct state.
Question.
That wasn't clear. If somebody's a New York resident and they have gambling winnings in New Jersey and they pay tax in New Jersey, why aren't they getting a credit on the New York return for the Jersey tax?
Because when New York looks at if you look at how the credit is calculated in New York, then they will say, I mean, it's very much akin to people that have intangible incomes that are residents of both states. New York will say, okay, you're a you paid tax on this to another state. So when they calculate whether or not you're going to get the credit, the ratio that they set up, they say, okay, well, how much of that was New Jersey source income? And even though New Jersey says it was New Jersey source income, New York will say, no, that's not New Jersey source income, that's New York source income, because you're a resident of New York. And so we're not going to include that as New Jersey source income when we do our credit calculation.
Unless you're a professional gambler.
Does that make sense? We can go. How did I go? Yep.
All right.
One more question.
Contemporaneous records. I won a jackpot last month in California and they issued me a W-2G. I didn't use the player's card.
Mm-hmm.
And I just keep a record and write down all the people I was with and contemporaneous records.
Well, as I said before, in the IRS, the question is, getting a W-2G well after the actual winnings occur, and going back to trying to keep contemporaneous records and keeping the names of people. I think, this is a good example as to why the IRS requirement of keeping the names of people you play with is ridiculous in part. And I think it's just something that they put down as one of the many things that you should keep, but I think it's an easy point to convince an auditor that, look, this is unreasonable. We have everything else here. If we don't have the people's names, it should be okay.
What if you didn't use the card? I have no record of it.
As far as just having to, I've dealt with this before where people just don't have good substantiation, don't keep the diaries, and again, you gotta do something to come up with an estimate.
Reliance on the card seems to be ill-fated. It's because it doesn't necessarily keep track of every single wager. So, actually keeping track of your sessions seem to be the IRS wants to see a diary. So, you could try with the cards, but that is secondary to what the IRS is looking for. All right, thank you very much again.
Thanks for that, Chris. Here's Bob back to finish off the afternoon.
That was fantastic.
So is yours. And so this one.
But we've all gambled on stage, so I'll give it to the back. But I wanted one or two